Let's talk about internal process risk. As the name kind of implies, this is a risk that is present when something goes wrong with a process. Maybe a step is skipped, maybe information is not properly recorded in a step, and so on. It can be caused by vague or complex processes, but also due to problems with controls. Let's take a look. Internal process risk is the risk of a failure in the bank's internal processes or procedures. It's what comes to mind to most people when they think of operational risk. Something breaks in a process, that's it. There are several subcategories within internal process risk, and they usually represent the actual reasons why processes fail. These include: first, wrong information. Having recorded transaction information, customer information, or other data in the wrong way. This results in sending a report to the wrong customer, executing a transaction with one extra zero, or any other variation of this. Besides wrong information, you can also have missing information. For example, transaction data, customer data, or other types of data that are simply not recorded. And this can occur both due to negligence, because someone forgets to complete a report or fill in a form, or for personal enrichment. For example, skirting anti-money laundering or counter-financing of terrorism compliance by processing a transaction with a sanctioned individual when the employee knows perfectly well that it's forbidden, but they get a bonus for transactions. So they don't record the individual's identity. Another reason is lack of controls. That is, the lack of systems to monitor transactions, trades, or other practices. The previous example fits in here as well. An employee can only process a transaction with a sanctioned individual if there are no controls that force them to do otherwise. Or another example is trading. Not having limits on trading accounts or trading disclosure can lead a trader to take massive positions and cause huge losses, such as the London whale scandal in JP Morgan or the collapse of Barings Bank. And finally, circumvention of controls is another one. And that example of the sanctioned transaction fits in here as well. It may be the case where an employee does have a control forcing them to disclose a suspicious transaction, which is usually filing an SAR or suspicious activity report, but the person consciously decides to circumvent that report in order to get that bonus. Usually, loss events resulting from internal process risk dictate that there is some kind of problem with the process for a given product or service. In other words, if the processes were good, there wouldn't be a lot of risk with them at all. But specifically, processes usually fail, first of all, are too vague. For example, the controls are not clear, or there is a high level of choice of the controls or documentation. Imagine a trader. The processes for trading are that they can disclose the trades to their manager or not, and they can disclose all accounts or just some of them, and they don't have to disclose all trades. There is a lot of process risk here. Second, the process does not have a clear sequence. For example, a new customer is being onboarded, for example, for a credit card product, but there isn't a clear sequence of steps. The employee knows that they must issue the card at some point or collect a form at some point, but they don't know the sequence. There is a very high probability that they're going to miss a step. And finally, if the process is just too complicated, if there are multiple workflows, documentation, and people involved, there's a higher chance that something will just fail. For example, imagine I have to do a report on a trading risk model. I have to fill 5 different reports on the same thing, on the same model, with the same content, maybe with small variations, all with different formats, and I have to deliver these to 5 distinct teams. And maybe the process isn't even the same for all 5. Chances are I am either going to forget to deliver that report, or cut some corners while doing it. What are some examples here? The first is that greed counts. One of the reasons why information may not be gathered or why the controls may actually be circumvented is personal greed. For example, opening accounts for sanctioned individuals because my bonus depends on the number of accounts opened or transacted volumes, or possibly a trader making higher risk trades because there's no penalty for losses, but they get a bonus as a performance fee of gains. Second, lack of controls is a dangerous term. Claiming that there are no controls is dangerous because in many cases, the fact that there are controls is no guarantee either, and those controls may not cover all types of risk. For example, there may be controls that force a trader to disclose one trading account, but they don't prevent them from having hidden ones. So when there's lack of controls, just placing controls isn't the solution to everything. And finally, ETL processes are a big offender in terms of IT. ETL is the acronym for extract, transform, and load, and it's usually the process through which data goes from the operational database, which is the short-term database with recent data, to the data warehouse, which is the bigger, longer-term structure with all data that's usually used for artificial intelligence algorithms. But what happens here is that in the ETL process, there can be simplification of data because the data warehouse and the operational database don't always use the same structure. And a big problem is when the ETL process simplifies data. For example, in fraud prevention, you have reason codes for chargebacks, which usually have two numbers separated by a dot, such as 10.1 or 10.2. An example is an ETL process that only stores the 10 in the data warehouse, but eliminates what's after the dot. So this leads to data loss and bad analytics. What are our key takeaways here? The first is that, as the name says, internal process risk occurs when something fails in terms of an internal process. A step was missed, information was wrongly captured or not captured, or some variation of these. There are usually 4 specific types of internal process risk. 2 are related to information, wrong information or missing information, and 2 are related to controls, lack of controls or active circumvention of controls by employees. Lack of clarity in a process is a problem. Internal process mistakes occur when set processes are not clear. Either the process is too vague, too complicated, or too messy. Clear processes are safer and involve less risk. So as we see, internal process risk is the risk of something going wrong with a process. It usually occurs when a process is not simple or when it's not clear, and it usually has 4 major subtypes related to either information or controls.